How to print money today for your portfolio using cash-secured puts, a 5-step guide. What is a cash-secured put? A cash-secured put is a sophisticated option strategy that can be a game changer for your investment portfolio. Here's how it works. You sell a put option on a stock you're interested in buying, but at a lower price than its current market value. This strategy involves you receiving an option premium up front, which is essentially income earned for taking on the obligation to buy the stock at a specified price, the strike price. If the option is exercised, the cash secured put part means you have enough cash in your account to purchase the stock at the strike price required. This strategy is ideal when you're bullish on a stock but would prefer to buy it at a discount. The beauty of this approach is that the stock price stays above the strike price, you keep the premium without having to buy the stock. However, if the stock price falls below the strike price, you're obligated to buy it, potentially at a discount to the current market price. The risk here is if the stock falls significantly below the stock price, but this risk can be mitigated by choosing stocks you're comfortable owning. It's a strategy that requires a balance of knowledge, risk management, and understanding of market dynamics. Can I see an example of a cash-secured put? Absolutely. Imagine you're interested in buying shares of company XYZ, which is currently trading at $100 per share. You believe XYZ is a solid company, but you'd prefer to purchase it at a lower price. To implement a cash-secured put, you decide to sell a put option with a strike price of $95, expiring in 1 month, which is $5 below the current market value. You get a premium of $3 per share by doing this, which is cash in your pocket. By selling this put option, you're agreeing to buy 100 shares of XYZ at $95 per share if the option is exercised, while receiving $300, $3 times 100 shares, in premium income up front. You ensure that you have $9,500 in your account, 100 shares times the $95 strike price, to cover the purchase if the option is exercised. If XYZ's stock price stays above $95 at expiration, the option will expire worthless and you keep the premium as a profit. However, if XYZ's stock price falls below $95, you're going to be obligated to buy the shares at $95, effectively purchasing them at a discount to the current market price. In this scenario, your actual cost basis would be $92 a share, which is the $95 strike price minus the $3 premium, assuming you get assigned. This strategy allows you to potentially buy a desired stock at a lower price while earning income from the option premium, making it an attractive option for investors looking to enhance their portfolio's returns. A 5-step guide to implementing cash-secured puts. 1. What stock do I choose? Look for a stable and fundamentally strong company that you wouldn't mind owning. The key is to select stocks that are likely to remain stable or increase in value over time. 2. What strike price should I pick? The strike price should be lower than the current stock price, ideally at a point where you'd be comfortable buying the stock. A common approach is to set the strike price around 1 standard deviation below the current market price. 3. What expiration date should I go for? Opt for put options with expiration dates 45 to 60 days out. This time frame offers a good balance between earning potential, income, and risk exposure. 4. Sell the put option. Once you've selected the stock, strike price, and expiration date, sell that option. You'll receive the premium up front, which is yours to keep regardless of whether the option is exercised. 5. How do I manage the position? Monitor the stock's price and be prepared to buy it if the price falls below the strike price. If the stock price remains above the strike price at expiration, you can consider selling another put after the current one expires. Enjoy this video? Please like it. Bonus, must know, rolling down and out. Rolling a cash-secured put down and out is a strategic move used in options trading, particularly when you're faced with the possibility of having the option exercised but prefer not to take ownership of the position in the underlying stock. This technique involves buying back the put option you initially sold and simultaneously selling out another put option with a later expiration date and time and a lower strike price. Essentially, you're extending the time frame and reducing the price at which you're obligated to buy the stock, thereby minimizing the risk of taking an unwanted position. For example, imagine you sold a cash-secured put for an option on stock XYZ with a strike price of $50, set to expire in 1 month. As the expiration date approaches, the stock's price drops to $48, making it likely that the option will be assigned to you. To avoid taking the ownership of the position, you decide to roll the put down and out. You buy back the $50 put option and simultaneously sell a new put option on XYZ, this time with a strike price of $45 and an expiration date 2 months away. By doing this, you receive an additional premium. which can help offset the cost of buying back the first put. Additionally, you now have a lower obligation price and more time for the stock to potentially move in a favorable direction. However, it's important to remember that the strategy also extends your risk exposure, as you're still obligated to buy the stock if it falls below the new lower strike price by the new expiration date. Rolling out and down can be a useful tactic in managing options trades, but it requires careful consideration of market conditions and your overall investment strategy. When do I use cash secured puts? Cash secured puts are particularly effective in high volatility environments, like when the VIX, or the volatility index, or implied volatility is elevated. High volatility typically means higher options premium, which translates to more income for you when selling puts. However, this also comes with increased risk, as stock prices are more likely to fluctuate significantly in high volatility environments. In such scenarios, it's crucial to be more selective with your stocks you choose and conservative with your strike prices. Remember, the goal is to generate income while minimizing the risk of having to buy the stock at a significantly higher price than its market value. This strategy is best suited for experienced investors who understand market dynamics and can navigate the complexities of options trading. It's not a get-rich-quick scheme, but a methodological approach to generating income and potentially buying stocks at a discount. Cash secured puts can be a powerful tool for generating income and strategically purchasing stocks in your portfolio. By understanding the mechanics of this strategy and carefully selecting your positions, you can effectively print money for your portfolio. However, it's essential to approach this strategy with knowledge, caution, and an understanding of the risks involved, especially in volatile market conditions. With the right approach, cash secured puts can be a valuable addition to your investment toolkit. Remember, this is not financial advice. Withdrawal Investing Insights, signing off.